Ever felt that gut-wrenching drop on a roller coaster? Now imagine that feeling, but with the entire global economy. That's what happened on October 19th, 1987, a day forever etched in financial history as Black Monday. It was the single largest one-day percentage drop in the Dow Jones Industrial Average ever. In just a few hours, the market plummeted by nearly 23%. To put that into perspective, it was almost double the crash of 1929 that kicked off the Great Depression. So, what on earth happened? How did a seemingly strong market fall off a cliff so spectacularly? Let's rewind the tape and investigate the perfect storm that created Black Monday. The 1980s leading up to the crash were a wild ride. It was the era of greed is good, big hair, and even bigger shoulder pads. The stock market was on a 5-year bull run, soaring to unprecedented heights. From the start of 1985 to its peak in August 1987, the Dow more than doubled. Everyone, from Wall Street pros to everyday folks, was piling into stocks, convinced the party would never end. This created a sense of euphoria, a classic bubble where asset prices became detached from their actual value. But beneath the surface, trouble was brewing. One of the key ingredients in this ticking time bomb was something called program trading. This was the new kid on the block, a revolutionary technology that used computers to automatically execute large volumes of trades based on preset conditions. One popular strategy was portfolio insurance. In theory, it was brilliant. Large institutional investors would use computer models to automatically sell stock index futures if the market started to fall. This was meant to hedge their portfolios, protecting them from losses. Think of it like an automatic braking system for your investments. The problem was, on Black Monday, everyone's automatic brakes slammed on at the exact same time. Before the crash in New York, markets around the world were already flashing red. The dominoes started to fall in Asia. Hong Kong's market was hit hard, and then the selling pressure moved west, sweeping across Europe. By the time the New York Stock Exchange opened its doors on Monday, October 19th, a wave of panic was already cresting. The pre-market indicators were grim, pointing to a massive slide. The opening bell didn't signal the start of a race. It signaled the start of a stampede. From the moment the market opened, it was chaos. The sheer volume of sell orders was overwhelming. This is where program trading turned from a shield into a sword. As prices began to fall, the portfolio insurance programs kicked in automatically, triggering massive sell orders for stock futures. This, in turn, drove stock prices down even further, which then triggered even more automated selling. It created a vicious, self-reinforcing downward spiral. The very tool designed to protect investors was now accelerating the collapse. The market was in a freefall, and the computers were steering it straight down. The technology of the day simply couldn't handle the unprecedented volume. The ticker tapes that displayed stock prices fell hopelessly behind, sometimes by more than an hour. Traders on the floor of the NYSE were flying blind. not knowing the real-time prices of the stocks they were trying to buy or sell. This information vacuum only amplified the panic. Imagine trying to sell your shares, but you have no idea what they're worth. And every minute you wait, you know the price is likely cratering. It was a recipe for pure, unadulterated fear. People started selling everything, not based on a company's fundamentals, but just to get out. But program trading wasn't the only villain. Several other factors fed the frenzy. The US was dealing with a large and growing trade deficit, and tensions were rising with major trading partners, particularly West Germany. Just days before the crash, the US Treasury Secretary made comments that suggested the US might devalue the dollar, spooking international investors. Furthermore, a proposed tax law change threatened the profitability of corporate takeovers, which had been a major driver of the bull market. These geopolitical and legislative clouds created a backdrop of uncertainty, making the market fragile and susceptible to a shock. Black Monday wasn't caused by a single event, but by a confluence of technology, psychology, and policy all coming together at the worst possible moment. In the midst of the chaos, the U.S. Federal Reserve, led by its new chairman, Alan Greenspan, stepped in. This was his first major test, and the world was watching. On Tuesday morning, before the markets opened, the Fed issued a simple one-sentence statement. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. This was a powerful message. The Fed was essentially saying, "We've got your back. We will print the money needed to keep the banks from collapsing and prevent the financial system from seizing up." They backed it up by encouraging banks to continue lending and by pumping liquidity into the system. This decisive action was crucial in breaking the cycle of panic. Unlike the crash of 1929, which spiraled into the Great Depression, the aftermath of Black Monday was surprisingly different. While the crash was terrifying, it didn't trigger a long-term recession. Why? The Fed's quick intervention was a major reason. It calmed nerves and ensured that the financial plumbing didn't clog up. Also, the underlying real economy was actually quite strong. Corporate earnings were good, and there wasn't the widespread bank failure that characterized the 1929 crisis. The market quickly found its footing. Incredibly, by the end of 1987, the Dow was actually positive for the year, and within 2 years it had recovered all of its Black Monday losses. So, what are the lasting lessons from that chaotic day? Black Monday served as a massive wake-up call. It exposed the hidden dangers of new financial technologies and the speed at which markets could move. In response, regulators implemented new mechanisms called circuit breakers. These are essentially automatic timeouts. If the market drops by a certain percentage in a single day, trading is automatically halted for a period of time. This gives everyone a chance to pause, breathe, and absorb information, preventing the kind of feedback loop of panic that fueled the 1987 crash. These circuit breakers are still a key feature of our markets today, and have been triggered several times since. Black Monday was a stark reminder that markets are driven by more than just numbers and balance sheets. They're driven by human emotion. The story of 1987 is a timeless lesson in the dangers of herd mentality, the illusion of risk-free profits, and the terrifying power of fear. It shows how quickly euphoria can turn to panic and how fragile our complex financial systems can be. It reminds us that while technology can bring efficiency, it can also introduce unforeseen risks. And perhaps most importantly, it highlights the critical role of central banks in acting as a backstop during times of extreme crises. Thanks for joining me on this deep dive into one of the most dramatic days in financial history. It's a fascinating story with lessons that are just as relevant today as they were back then. If you found this interesting, don't forget to hit that like button and subscribe to the channel for more explorations into the events that shaped our world. Let me know in the comments what you think. Could a crash like Black Monday happen again? We'll see you in the next video.